name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The long-term construction of bearish patterns which have been prattling on about now interminably here for weeks is not only continuing but coming to fruition. At the start, this had been in the form of a somewhat sideways rectangle pattern between 1578 and 1734. Then the market veered towards a shallow bear channel, currently 1473 to 1651. More recently towards a breached and now broken June-based bearish shift pitchfork, with the market moving between the upper time, currently 1508, the middle time, currently 1442, and the lower time, currently 1375. Late last week, with changeover, the market gapped below the 50% Fibonacci line of the interesting December 2020 to February 2022 move at 1451. In the process, the market reached down to target X1, the harder reach secondary target for an older sideways triangle that has become synonymous with the more recent sideways rectangle. It also meant that on the continuous daily chart, such as the one I used, the market had formed a weekly key reversal down last week. Now, I'm not comfortable with such weekly key reversals down, but I cannot deny that they do exist. Additionally, it ties in with the monthly key reversal down we had here in June. One other important feature. Yesterday, the market punched down through and closed below the interesting August 2020 to date uptrend, currently at 1355, further endorsing its bearish credentials. So where next? Well, below we have the congestion formed from the lopsided diamond pattern between 1300 and 1180 over October to December 2021. Now, within this congestion, we have two 50% Fibonacci lines: the April 20 to February 22 move at 1289, and the May 19 to February 22 move at 1275. If you wanted to pin some levels within the diamond pattern, then these two would be a good start. I would only add one further point. Getting down to the lopsided diamond pattern would mean that beans are no longer in the teens. And should the old lopsided diamond pattern fail to slow and halt the decline, then the prices, well, if they breach that lopsided diamond pattern, they could be back to under the $10 level as well. Chicago soybean meal. Okay, so I've previously spoken at length about the topping action over late January, late April that turned out to be a head and shoulders top with a split head. In late April, the market breached and closed below the neckline, currently at 453.20, and triggered the pattern which subsequently fulfilled all the opportunities, primary and secondary, on the downside. Now, a significant part of the erosion of the move lower has been and is still out there. It is the market's reluctance to testing, and this week to failing to properly so far break below the slowly rising long moving average, and that's currently at 407.70, as well as initially it was the 50% Fibonacci line of the August 21 to March 22 move at 386.80, but more recently it's been the nearer 50% Fibonacci line at 400.50 of the October 21 to March 22 move. The most recent features have been, and they are in no particular order, the completion of a small late May to June based triple bottom, a May to July reverse head and shoulders pattern that looks like a less common bearish continuation pattern, the failure of the market to break the declining medium moving average on the top side, and the consolidation of the May to date rising expanding wedge pattern, currently at 400.20 to 450.80. Into what it actually is now. It is the primary pattern for this market. There is one more final feature, and it's best a dubious feature, as it was made over a type of changeover, and that is the weekly key reversal down last week that was only possible because of the gap through on the continuous daily charts that I use. Now finally, there is a longer term pattern that continues to require consideration. I described it thus 7 weeks ago and ever since, and I quote, "Second possible longer term pattern, should it come about, may be strategically massive. It is to regard the whole action since mid-December 2021 to date as a huge head and shoulders pattern. This head and shoulders pattern has the original February to April action head and shoulders top as a crown on the large head pattern. Now, before you start jumping to conclusions, yes, head and shoulders patterns, as we have seen here recently, are usually regarded as topping patterns. But, and this is an important but they can also be possible continuation higher pattern, a possible continuation higher. And just because the last head and shoulders pattern seen here was a topping action does not mean that this larger one will be, or in other words, post hoc ergo propter hoc. And I think it is really important to stress that point, and that's the end of the quote. The neckline here, currently 40020, is closely associated with the long moving average, currently 40770, and the 50% Fibonacci line at 40050. The neckline long moving average have been at the core of what has held up this market. Well, holding up the trigger for this large head and shoulders pattern seems for a while to be turning it towards a continuation pattern. Continuation higher, that is, but as the long moving average is now heading higher, splitting away from the other supports, it's worth considering looking at as a possible break. Hasn't done it yet, but it is awfully close to it. The next test, much like last week, will be to see if any recovery has some legs on it or not. Chicago soybean oil. The market made a new all-time high at the end of April. However, the peak on the last day of April was made with a bearish pattern, a bearish engulfing pattern, if only just. And we subsequently saw prices fall down, even gapping lower, down till just after mid-May, when they seemingly stabilized. This was caused mainly by the then rising short-medium moving average, currently at 74.72. However, in mid-June, the market made a bearish belt hold pattern, a pattern that is one of the most consistently daily bearish patterns available out there. Prices dropped down again. After that, much more aggressively, halting 4 weeks ago, not at the long moving average, which is currently at 67.03, which is where one would have expected it to see a halt, though that did have some strong calming influence on the market, but at the 50% Fibonacci line of the big January 21 to April 22 move at 64.09. The reactionary move back up only lasted until the June 21 high at 64.84, and that's 3 weeks ago, before prices started to resume their journey lower. Congestion highlighted in my earlier commentaries between 57.64 and 59.44 has halted the decline since then, despite being penetrated, but it has been a case of lower highs on any bounce out of this congestion, a sign that the bearish pressure has not dissipated. Last time I asked 4 questions that needed to be answered. First one was easy. With a short medium moving average currently at 72.53 and the medium moving average currently 73.59, make a dead cross? The answer was simple. Yes. This is now a lagging bearish indicator for this market. Second is also easy to answer, but it took until last Friday to confirm, and that was whether we'd see a weekly key reversal down last week. The answer was also yes, and was another bearish factor. The last 2 questions are more difficult. We have the possibility of 2 bear flags from the June to date action. The first one has a potential target X in the 51.55 area and is still live as an idea, though the beginnings of a congestion construction seen over last week and this week have not helped. Second has a potential target X1 in the 52.25 area. This last one, well, I'll leave it there for the moment, but I have less confidence in it than last week and I may retire it next week. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Service International Limited. And here comes the final bit.